We're doing investment appraisal. Okay. Tell me, what do you understand by investment appraisal?
Basically you're investing your funds in a project, so how much return you're getting on for that project.
But what do you mean by investment appraisal?
Um, like you're investing your funds into a particular project.
Hmm.
And
Investment appraisal.
I'm sorry, miss, what?
What do you mean by appraising an investment or investment appraisal?
Increasing its value over a period of time, I think.
See, when I'm talking about investment appraisal, I am basically assessing. Assessing means I'm checking whether I should invest in this particular project or not.
Okay.
Okay. Should I invest my money in project A or should I invest my money in project B or not? So when I
Hmm.
talk about investment appraisal, we are trying to assess whether it will be beneficial for us to invest in a project. Now, which projects are we talking about? Which projects are we talking about?
Mm,
We are talking about capital investment. Whenever I
yeah.
have to do capital investment, that means I am looking to invest a huge amount of money in any project or in anything that I want to invest in. So when I am
Yeah.
doing a huge investment, I will definitely try to see the return that I am going to get from that investment.
Okay.
When I see the return that I am going to get from that investment, I will use some techniques to find
Hmm.
out the return that I will get from that investment.
Yeah, certain calculations.
Okay, I will use some techniques or I will use some method that will tell me whether investing in this project is beneficial for me or
Mm-hmm.
no. Those techniques are called
Hmm.
investment appraisal techniques. So my first
Okay.
thing is, what is investment appraisal? What
Yeah.
is investment
Uh,
appraisal?
invest Investment appraisal is the process of assessing whether investing fund is whether it is worthwhile to invest funds into a particular project.
So when you are assessing whether it is worthwhile to invest in a particular project or no, you will use some techniques to find out whether you want to invest or no. So those techniques are called what?
Investment appraisal techniques.
There are four techniques which we use to find out whether you should invest in a project or no. And the name of those
Hmm.
techniques, these four techniques are accounting
Invest.
rate of return,
Yeah.
payback period, net
Mm-hmm.
present value, or internal rate of return. I'm repeating the name of those techniques is accounting rate of return, payback period,
Hmm.
net present value, and internal rate of return. It's a very important
Yeah.
chapter, very important from your exam point of view, and it's
Hmm.
basically formula based, but reading the question is very important. So we will start with our first technique. My first technique is what? Accounting rate of return.
Accounting.
So when
Hmm.
I am talking about the accounting rate of return technique, this technique is concerned with profitability. Okay, so when I say I want to see whether it is worthwhile to invest in a project or no, I will only see whether I am making profits from that project or not. If I am
Hmm.
making profit from that project, I will invest in that project. So you find
Yeah.
out the accounting rate of return of that project. The formula to find out the accounting rate of return is average profit over average investments.
Investment.
Okay. Average
Yeah.
profit over average investment. Average profit means that the total profit that you are making over the life of your investment. How do you find average profit?
Yeah.
Total profit that you're making over the life of your investment, and you will divide it with the life of investment. Are you with me? Okay.
Record to करो.
So the first technique that we have to assess our investment is called the accounting rate of return. Can you tell me the accounting rate of return is concerned with what?
It's concerned with the profitability
It is concerned with
and
profitability. You will not see
yeah,
cash flow. You will not see how much money is coming in. You will only see
yeah,
if your investment is profitable or not. If
profitable.
it is
Yes.
profitable, I will invest in that project if I am using
Hmm.
the ARR technique for investment appraisal. Okay. How do you
Yes.
find out whether the project is profitable or not?
So you take the average profit upon the average investment.
Is the
So
formula to
yeah.
find out the profitability from the project. It is
Hmm.
accounting rate of return. Accounting rate of return will be equal to what?
Average profit upon average investment.
How do you get the average profit?
Total profit over the life of the investment upon life of the investment.
Okay, so total profit over the life of the investment divided by life of investment. How do you get your average investment?
Uh, the cost of initial investment minus residual value of the
So your
investment upon.
initial investment cost minus the scrap value from the investment,
Yeah.
that when you will divide it by 2, you will get your average investment. Okay,
Yes.
if your accounting rate of return is higher than your return on capital employed, then your
Mm-hmm.
ROCE, that means this project is profitable and you can invest. What do I mean
Hmm.
by return on capital employed?
Return on capital employed is the profit upon capital employed.
So when you employ
Profit.
your capital somewhere else in the market,
Mm.
you may get this
Yeah.
much amount of return. That is return on capital employed. And ARR will give you the return that you are going to get from the particular investment. So if your
Hmm.
ARR is more than your return on capital employed, that means outside you're going to get a lesser return. Now you're going to get a higher return. So if your ARR is more than your capital employed, then what? You
If
should
your AR
invest.
is healthy also, it's a profitable project.
It is a profitable project and you should invest in your project. Okay. Now, there is one short question.
Mm-hmm.
This question, I want you to calculate the the accounting rate of return. How will you calculate
Okay.
your accounting rate of return? This is a question. You have to calculate your accounting rate of return. Think about how will you calculate your accounting rate of return. What is the formula for accounting rate of return?
Average profit upon average investment.
It
So
is
first you find
average profit upon average investments. What is the meaning
uh,
of average profit?
total profit from the project investment over the life of investment.
And average investment is?
The cost of initial investment minus the scrap value of investment upon two.
Okay. So let's do this sum and
Yeah.
then find out your ARR.
So first total profit over the life of the investment. Mm. So annual receipts is the total.
Let's read the question. Okay. What is the question saying?
Hmm. It says that the directors of P Limited plan to launch a new product which has expected life of 4 years. A new machine is required for this, and directors are considering buying machine X.
And
Details of machine X.
directors are considering to buy a machine X. That means directors are considering for an investment. So
Yeah.
whenever you consider for an investment, you will first use investment appraisal techniques
Mm-hmm.
to find
Yeah.
out whether it is profitable or not, or to
No.
find out whether you should invest in a particular project or not.
Hmm.
Okay, fine. You're planning to invest in buying machine X. So you
Yeah.
have details of machine X, which is as follows. What is the details?
Yeah. So they have written the cost of it, and the annual receipts and annual payments are given.
Okay. And
Then there,
hmm,
yeah, useful life is 4, so depreciation is a SLM method.
no residual value.
Yeah.
Depreciation is SLM method. They ask you to calculate ARR. Now, when they
Hmm.
ask
Yeah.
you to calculate ARR, what will you do? How do you calculate ARR?
Yeah. So you'll average profit upon average investment. So to find
Average profit
the
over average investment. To find average profit, what do you do?
life, no, sorry,
How do you find
profit
that
over
average
life,
profit? From your
profit
receipts, you will
hmm,
minus your expenses.
and your depreciation.
Expenses, that means your cash expenses
Mm-hmm.
and your non-cash expenses. So from
Yeah.
your receipt, you will minus your expenses. It can be your cash expenses, it can be your non-cash expenses, and you will get profit. So first
Yeah.
thing I will try to find out my average profit.
Yep.
Okay, I have 4 years. My annual
Yeah.
receipt is 390,000. Start
Mm.
writing
Yeah, written.
20,000, 460,000, and 370,000. This is my receipts.
Yeah.
My payments would be 280,000, 280,000, 270,000, and 250,000. But from the
Mm.
receipts, I will have to subtract all my payments. That means my annual payments and also my depreciation.
Yeah.
How will I get
Depreciation.
my depreciation?
So cost upon the residual, sorry, cost upon the useful life.
Minus residual value upon
Mm.
the estimated useful life. Estimated useful life is 4 years.
So 100,000. So it remains same for all years.
It remains the same for all the years. Then
Yeah. So for year one, it's 10,000 profit. For year two,
10,000 is the profit. Year
yeah,
two,
40,000. Year three, 90,000. And year four, 20,000.
now what you will find out?
Now you need to know, one
Average
second.
profit.
Total profit over the life of investment. So you'll
First,
add all the
average profit. Average profit is what?
profit.
You
Yeah,
will add,
total.
yeah, total
Yeah.
profit.
So you'll add. So
So
10
your
plus 40
total
plus
profit
90
is
plus
10 plus 40 plus
1.
90 plus 20.
Hmm.
160,000. This is your annual profit.
Yeah.
Correct?
And you,
You
yeah,
have to
divide
find
with
the
this
average annual profit. What do you have to find?
average annual profit. So,
Average annual profit
you,
will be,
so 160,000 upon life of investment, which is 4.
so average annual profit is how much? 40,000.
Is 40,000. Yes.
Okay. Can you give me the formula for ARR again?
Yeah, and sorry, average profit upon average investment. And for average profit, you'll do your annual profit, which is you'll add all your profits upon the life of investment, which in the sum is 4. So you'll get 40,000.
Okay. Now average investment, how do you find out?
Yeah, so for that, you'll do the initial cost in the cost of
Cost
initial
of
investment
investment minus
minus the residual value of the investment. So the scrap value of the investment.
divided by 2.
2.
What was the
Yeah,
cost of your investment?
40,000.
Yeah, 40,000. Is there any residual value?
No, no, no.
No. So
upon
40,000 minus 0 upon 2.
upon
So
two.
your
Yeah.
average investment is
20.
200,000.
1 second.
What is the
Uh,
cost of the investment?
oh, sorry, it's 400,000, not 40,000. My
Cost of
bad.
the
Yeah,
investment
yeah.
is 400,000.
200,000.
So
Yeah.
average
Hmm.
investment would be 200,000
Uh, hmm.
minus
So,
0
yeah, upon two.
upon 2. So your average investment is 200,000.
Yeah. So your ARR will be 40,000, which is your
What is
average profit.
40,000? This is your average profit.
Profit, yeah.
What is 200,000
Average investment
into
in 200.
100? So your
So
ARR is
20%.
20%. So this is how you find your ARR.
Yeah.
Okay.
Okay.
Now you
Yep.
need to know your advantages and disadvantages of ARR. Okay.
Hmm.
So ARR is concerned with what?
It's concerned with the profitability of the investment.
It is concerned with the profitability of the investment. You not need to know the advantages and disadvantages of calculating your ARR. What is the advantages of ARR? First thing is
Yeah.
that it is easy to calculate.
Hmm.
Second thing is it measures your profitability. Okay, that means
Yeah.
it takes also depreciation expenses into consideration.
Actually. Hmm.
Okay, so two advantages of ARR is it is easy to calculate and it is a measure of profitability, not the cash flow. It also takes depreciation into consideration. What is the
Hmm.
disadvantages of ARR? Disadvantage is that when you are trying to find out whether you have to invest in a project or no, you will never see your non-cash expenses. When
Hmm.
you want to make any decision, you are only concerned with your cash flow. Cash flow means if you are able to recover your investment and something more than that, you should invest. But
Hmm.
ARR does not take cash flow into consideration, it takes profitability into consideration. So,
Okay.
this is a disadvantage of it. The second disadvantage of ARR is that it does not take into consideration the time value of money.
Hmm.
Okay, so two disadvantages of ARR. Can you tell me?
Yeah. ARR uses profit. However, cash flows are more important than the accounting profits, and ARR fails to take into consideration the time value of money.
Okay, let's do one more question, which is a past paper question.
Hmm.
Let's do the second question, which is like past paper question of J Limited. Read the question, please.
Yeah, the directors of J Limited plan to buy a machine costing $550,000. The machine has a useful life of 4 years with no residual value. It is expected that the machine will
Can
generate
you
a
tell
net.
me the machine costing 550,000? It is the cost of your investment.
Yeah. Hmm.
Okay. So this is your cost of your investment. Okay, fine.
Hmm. And useful life is given as 4 years.
Okay. Then,
It is expected that the machine will generate a net cash inflow of 200,000 for each of the first 2 years, followed by a decrease in 10% in year three, and decrease in a further decrease of 10% in year four. The cost of capital will be 10%.
okay, they've given
And
you cost of
hmm,
capital and they've given you some discount factors. What do they want
yeah,
to calculate?
ARR.
ARR. Come on. Can you tell me how will you calculate ARR?
Yeah, first you will find the profit for each year.
How will you find the profit for each year?
Mm, So net cash inflow means receipt. So you'll write that. So for year one, it'll be 200,000.
So let's start. First, we'll write the
Oh,
formula for ARR.
yeah,
ARR
yeah. Okay.
is what?
Average profit upon average
Upon average
investment.
investment. When you say average profit, what do you say? You will say average annual profit. What will you say?
Average annual profit.
Over life of investment.
Yeah. So first you'll find the annual profit.
So you have year 1,
Hmm.
year 2, year 3, and year 4. What is your?
So, so inflows, cash inflows given, which we
They
take
have
as
given
receipt.
a net cash inflow. What do you mean by net cash inflow?
Net cash inflow will be cash inflow minus cash outflow.
When they use the word net cash inflow, it means inflow minus outflow.
So,
Okay.
yeah, fine.
So they have
So
given
net,
net cash flow.
hmm.
Net cash
So
inflow. That means
hmm.
receipts minus payment is already
Minus
calculated
payment on
for
plan.
us.
Yeah, fine, fair.
Okay, fine.
So for year one, it'll be 200,000,
Hmm.
and for two also remains the same 200,000.
Hmm.
Then for year three, it'll decrease by 10%. So 10% of 200,000. So 180,000.
Hmm.
And then more 10%. So minus 18.
80,000's 90%.
160. Huh. One 1 second. 162. Yeah. 162,000.
Then
Then 1 second. Uh, there's
the
cost of
rate of
capital.
return takes what into consideration? It takes the accounting profit into consideration. When
Yeah.
it takes the accounting profit into consideration, that means you will also minus
Mm-hmm.
receipts minus payments. That means this is cash expenses you're minusing. Other than
Yeah.
the cash expenses, you will also deduct your non-cash expenses.
Yes.
So you will also deduct non-cash expenses. What is the non-cash expense?
Non-cash expense. Do you mean discount factors?
Non-cash expenses depreciation.
Achha, yeah, but then cost of capital will be 10%. It's
That is
given.
another thing. Cost of capital
Achha,
is
okay.
for making a decision whether you have to invest or not.
So 1 second. So depreciation would be the cost upon the useful life.
Okay, cost is how much?
550,000 upon
Residual
4.
value is 0.
Yeah.
Useful life is 4 years. So what will be the amount of depreciation?
137,500.
13,137,500. Okay, it will be the same for all the years.
Yeah.
Okay, then you will get your accounting profit.
Yeah. So, for year one, it's
Can you please
62,500. 62,500 for year
just
one. Yeah.
so what is the profit for year 1?
62,500.
What
Same
is
for year
this
two.
profit called?
Annual profit.
Okay. Average annual profit over the life of the investment. What is it called?
Average annual profit over the life of investment.
Okay, so how will you find the average profit? Okay, year 2 is 42,500 and this is 24,500. Are you with me?
Yeah.
Yes. So what is
Yeah.
average profit? You will do the total of all of
Yeah.
this. So the total of
So 192,000
192,000. So average
upon.
profit is 192,000. Average annual
Sorry.
profit over the life of the investment will be
Yeah.
192
Upon
divided
4.
by 4. That is why we
So
say over the life
40.
of investment. 48,000. What is
Hmm.
average investment?
550,000 minus
Of
0
the
upon
investment minus
upon
residual value
upon 2.
on 2. So average investment will become 275,000.
Uh, yeah. Hmm.
Accounting rate of return,
48,000 upon 27500. Sorry,
average
275.
profit over the life of investment over
Yeah.
average investment, that is 275,000 into
Hmm.
100. So it is what?
7.5.
17.5%.
Yeah.
If your cost of capital is 16,000, advise the directors whether you should purchase the machinery or no.
Cost of capital 16%. Hmm.
That means if your return on capital employed or the money that you require to buy the capital is 16%, should you purchase the machinery or no?
Yeah, it's less than the this thing, no? Than ARR.
Yes, it is less than the ARR, so you should purchase the machinery. Now
Hmm.
let's finish it. Tell me, what is investment appraisal? I want you to write this. What is
Okay.
investment appraisal? First tell, then you can write it.
Investment appraisal is the process of 1 second. The process of knowing whether it is worthwhile to invest funds into a particular project.
Name the four investment appraisal techniques.
Accounting rate of return, then payback period, then in uh, net present value and internal rate of return. Yeah.
Okay, when I talk about the accounting rate of return, what does it take into consideration?
Takes into consideration the profitability and not the cash.
Into consideration.
What miss?
Which profit does it take into consideration?
Average annual profit.
Accounting profit.
Acha, okay, accounting
It
profit.
takes accounting profits into consideration. That means it is what? Receipts
Receipt minus payments
minus payment.
minus
Which types of payments does they minus?
cash
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 expenses and
and non-cash.
non-cash expenses. Non-cash expenses is also called what?
Depreciation.
Depreciation. So all the receipts minus payment will give you what? Your profit. Accounting.
Prof. Pro,
Okay.
हाँ,
If it is
yeah.
only receipts, that is inflow
Hmm.
minus outflow. If it is only receipts, inflow minus outflow, that means it is called another word for
Net cash. Net
net
cash inflow.
or net cash
Hmm.
flow, or you can say net cash inflow. From net cash
Hmm.
inflow, you will minus one thing to get accounting profit. What is that?
Depreciation, which is a non-cash expense.
You will minus depreciation and you will get your accounting profit. Give two advantages and disadvantages of the investment appraisal technique.
Advantage is that it is easy to calculate and understand, and it measures the profitability, not the cash flow, and depreciation is also taken into consideration. Um, yeah, and the disadvantages would be that ARR uses accounting profit. However, cash flows are matter more than the accounting profit, and ARR fails to take into consideration the time value of money. Yeah.
Fine. Now there are two questions which I want you to solve. The first
Okay.
question is the reinforcement one. It is a worked example one. Okay,
Mm-hmm.
you have to calculate the ARR of the machinery and you have some additional information where you have to state with reasons whether you should buy the new machinery or not. This is the first question. And the second question is again, it is to calculate the ARR. You will write the
Yeah.
steps in full and then you will calculate it. Okay.
Okay.
So this is the MS of the reinforcement one. Okay. The reinforcement MS is this one. So you can see this. The first one, Planners Limited.
Okay, okay.
Okay.
Fine, I'll do it. Fine, I'll do it.
And the second one, the mid plenary again. This is your answer for that. So you have to complete these two sums. And after that, we will go to the second method. And the second method is the payback period method. Okay.